particular place, basically the market and the customers are very different from here, so it's hard to क्या कहते हैं, to observe the market or to scan the market, that what kind of product we should make. uh,
Yes. It is unpredictable. I mean, we have to do our homework, right? But it is very much unpredictable. There's so much of uncertainty. You have uncertainty related to the interest rates, you have uncertainty related to the foreign exchange rates, you have political risk or the country risk, and coupled with the intense competition and the unpredictable behavior of the consumer. So one has to undertake a lot of studies, risk reports have to be prepared, and then with a certain amount of risk in your mind, you know you need to proceed. I mean, you just simply cannot say that, oh, this is risky, so we'll not go ahead with this project. The only thing is, when you are able to predict something, so it gives you, or it equips you with a certain amount of tools and techniques, how you are going to manage that risk. I mean, this is where lies the acumen of management, students, and academics. That risk will always be there. There is no risk only when you do nothing, right? When you are doing nothing, there is no risk. But some people say that even there is a risk in not doing anything. So you have to manage the risk. You have to understand the nature of the risk involved, and then you have to, you know, identify suitable techniques how to manage the risk which is involved. Okay, are we together?
Yes, sir.
Okay.
yes, sir.
Okay. So now when we talk about the international projects, number one, the amount of investment which is required is very high. Excuse me. And it is definitely a strategic decision. It is not like opening a shop which you can close anytime. Millions of dollars are involved, lot of approvals and sanctions from the appropriate bodies have to be taken, and setting up factories, hiring people, roping in the suppliers. So there are a lot many stakeholders besides the multinational corporation itself. So whatever steps you have to take while entering into the foreign markets, in setting up your factories or subsidiaries, or committing your funds for a long period of time, maybe 5 years or 10 years, excuse me, we need to look at the entire situation in a more comprehensive way. What are the possible benefits, and what could be the possible threats? So different types of analysis have to be done, whether it is a SWOT analysis, whether it is a political and economic analysis, besides the financial analysis. Are we together?
Yes,
Yes, sir.
sir.
Okay. So When you are going abroad in a foreign country, on one hand, you have your own equity, the money which you are investing, based on your goodwill, based on your credit worthiness, you may also be able to, raise some amount of debt from the market. So you have an additional borrowing capacity. Many times it happens that the country in which you are going to operate, they offer you a tax holiday, maybe for a period of initial 5 years. They, kind of a red carpet welcome is given, that okay, we will not charge you any corporate tax for the first 5 years, or we will give you some concessionary loans, some subsidies, lower cost of labor, lower cost of raw material. So these are some of the advantages. But at the same time, you may also face political risk, which can be in the form of expropriation. Maybe the government would want to close down your business and, take over your production facilities. Sometimes, if you are if you don't have the, you know if you are unable to finish some project on time, so some kind of penalties may also be imposed. So it is basically a decision which you have to make in the light of all these, advantages, as well as the disadvantages, or opportunities and threats, as you may say. So with this brief framework, we will start our discussion on international project appraisal. I'll share a few slides with you, which I have already sent to you. I hope it is visible.
Yes, sir.
Okay. An important technique that you will come across in case of the multinational capital budgeting. I'm sure you have already studied the net present value approach or internal rate of return. These are the traditional approaches which help in the capital budgeting decisions. In case of multinational capital budgeting, excuse me, I think there's some. Can you just wait for a while?
Yes, sir. Sure.
I think there's some visitor. I just All right. Are we together?
Yes, sir.
Yes, sir.
Okay, good. Thank you so much for bearing with me. So, what is the idea behind the net present value approach? Yes,
Sir,
So it
net
is
present,
just give
basic.
me some idea. Yes, please. Yes.
sir, net present value is the expected value of the future cash flows.
Okay. And it is basically it is the difference between the initial payments or the initial investments that is done right now at the beginning of the project, and then after 1 year or maybe a longer time you have the cash inflows. So those cash inflows which are expected to take place deep down in the future, so you need to bring them at the same level. You need to discount them using an appropriate discounting factor and with respect to the year in which they are expected to accrue or come to you. So as long as the net present value is more than zero, you can say that the project is profitable or it is expected to generate profits. Okay, let me just. So when we talk about the international capital budgeting, there is an alternative approach which is more comprehensive. If possible, I'll try to share with you. I mean, it's that numerical example is already there in this presentation, but if it is possible, then we'll discuss it also. Now, this adjusted present value approach is based on the principle of value additivity. What additional value is being added to the project on account of, say, concessionary loans, on account of certain subsidies, on account of tax free holidays. So, and one more important factor of the adjusted present value approach is that different cash flows, they need to be discounted using an appropriate discounting factor. It should not happen that a uniform discounting factor, that is the rate of interest or the going interest rate in the market, is being used for all the cash inflows. Rather, there should be a distinction made, and accordingly, more appropriate factor should be considered. So, this approach is more comprehensive. If possible, I'll try to share some write ups on adjusted present value approach. So, we have already talked about the net present value approach. We have already seen this. We have seen the internal rate of return. So, internal rate of return is more or less similar to the NPV because it is that rate of return at which if the cash flows are discounted, then the NPV is equal to zero. There are other approaches as well, like the payback period, that after how many years the initial investments would be returned or they would be recovered from the project. So when we are talking about, now there are obviously with the passage of time, these traditional approaches, they have a limited utility. No doubt they serve as the background, they serve as a foundation for developing an understanding about the projects. However, an important, constantly the researchers as well as the practitioners, they come across different parameters, different benchmarks, which help them in analyzing the situations. So, an important thing that we need to understand, and I'm sure you already must have, you know, done this in some other courses as well. There's a concept of incremental cash flows. So, when you are investing in a new project, so there is a need to understand the total cash flows from the overall projects that a firm is having, and what is the incremental or additional sales or cash flows have been which have been generated by setting up a new project. So it's an approach which compares the corporate cash flows. It gives, it's an overall holistic picture. The corporate cash flows without investment, that means when no additional investment was made, what was the cash flows? And what are the cash flows after the investment is made? That is the post investment cash flows. So, if there are no incremental cash flows, if the situation remains more or less the same, then obviously it does not speak in favor of setting up new, subsidiaries or production affiliates or any other facility which would involve heavy investments. Now, when we are talking about incremental cash flows, some of the considerations that we need to bear in mind. Number one is the cannibalization. That means your own production facility, a new production facility, it may eat into the sales or cash flows of the existing facilities or existing production facilities. So, as it is mentioned, a new investment or product takes the sales away from the existing product line. A foreign production plant, its production may substitute the exports which are being made by the parent company. Obviously, when you are setting up a plant in some place, so it will not only cater to the domestic market of that country, but it will also cater to the export market of the nearby or the neighboring countries. So that is why the concept of incremental cash flow is very, very important. So if the investment replace other existing cash flows that otherwise would have existed, then these cash flows need to be subtracted from the investment total cash flow in order to obtain or in order to know what additional or incremental cash flows have been, you know, added to the company. Just the opposite of cannibalization is the sales creation. So we just have to look at if the new facility, if the new investment is leading to increasing cash flows at the other production sites. So both ways you have to look at. You have to look at the cannibalization aspect as well as the additional sales creation. The other important issues is which needs the attention of the investors is the opportunity cost. Can somebody quickly give me an idea what exactly is opportunity cost?
Basically, sir, it is the next best cost option that is available to us by giving the other option, by giving up the other option
Very good.
in terms
Because
of
if you are
growth.
yes, very nice. If you are investing in one option, so naturally you are foregoing the other options. So you are letting that, opportunity go by. So there is a cost to it. You are choosing one opportunity over another. So that is the opportunity cost. So that is something which needs to be considered. And finally, the transfer pricing and other taxation issues, that transfer prices that we have already talked about. Other cash flows we were talking about yesterday when we discussed the working capital management, the fees and the royalty which needs to be paid to the parent company, right? So the firm's charges of legal counsel, power, heat, rent, research and development, headquarters staff, all these. So they should also be included in the capital budgeting process, because if the investment is leading to additional expenditures, then it needs to be considered. And the intangible benefits like the learning experience, broader knowledge base, higher competitive skills, better goodwill, right? Better reputation. So some of these things, obviously, you cannot quantify them, but while making a decision, you need to keep in mind these intangible benefits as well. We will not talk about the adjusted present value today. We'll try to have a look at another type of, uh, you know, uh, advantage or another approach, which I am sure you'll find different to what we have already been exposed to. And that is a very, very unique concept of growth options. This is a very unique example of growth options. Those of you who are into the habit of reading the books. So this example is taken from the book Multinational Financial Corporation by Alan C. Shapiro. Now, the approach, that is the discounted cash flows or the net present value approach, even the adjusted present value approach, they are all considered to be static approaches. That if you have made a decision, then nothing can be done about it. Once you have committed funds, and once you have envisaged or expected that in the forthcoming years you are going to you know generate a certain amount of cash inflows, so the things will remain the same. The system is going to maintain the status quo, and that is why it is called as a static approach. However, as it is mentioned, in reality, opportunity to make decisions contingent on information that becomes available in the future. There is a possibility that you can change your decision. That is a basic idea behind the concept of growth options, that it is not necessary that from a particular project, if you have expected cash inflows, say for example, let us assume that it is going to be, say, rupees 50 lakhs per year, and the initial investment is, say, 5 crores that you have made already. So you know about the investment, and the future cash flows, that is that it is based on the estimates. You are estimating it to be, say, rupees 50 lakhs per year. So there is every possibility that the future cash flows may be affected affected by some event, by the expansion of the market. So some events can affect your cash flows in a positive way, and some of the events may affect your cash flows in a negative way. And that is why the managers should not adopt a closed ended approach or a static approach towards the projects. It should be a more dynamic approach. As it is mentioned, the ability to alter or change the decision in response to a new information in the future has a value similar to an option that should be incorporated in the investment analysis. So one should be open to any type of possibility, any type of contingencies. If need be, then you can, close your operations. There is no need to follow or pursue, keep on pursuing a project which is turning out to be loss making. You have already involved, you have put in money, and once you realize that it was a wrong decision to put money into that, so it is better to wind up and you know take whatever salvage value, whatever money that you can recover from that project, and then don't waste your time and resources and energy on a project which is appearing to be you know loss making. So it should never happen that you have invested in an in a project, and once you realize that it is making losses, so you keep on sticking to it unless you have a very strong reason. Maybe you were already mentally prepared that okay, for the initial 2 years or 3 years this is going to bear losses, and subsequently you will have the profits. Unless you have this kind of confidence, then you can continue. But if your project is going against your predictions, and especially if some event that has taken place, maybe some political event that has taken place which is against your project, so in such a situation a much better strategy would be to wind up and dedicate whatever money that you can recover from that project into some other business opportunities, rather than just keep continuing with that loss bearing project. So here is a very beautiful example. Now I hope all of us are together. We'll just discuss this example today.
Yes, sir.
Okay, am I audible? Can you see this?
Yes, sir.
Okay. Now there's a case. Obviously I have given a very brief account of the case is given in that in the book by Alan C. Shapiro, that there's a decision to reopen a gold mine, right? And there is a fixed cost of 1 million US dollars to open the mine, right? So that is the initial fixed cost. And it is expected that there is 40,000 ounces of gold in the mine. Okay. So there's a huge amount of gold which is there to be mined. And there's a variable cost that is for mining the gold. One fixed cost is the 1 million US dollars that is there for obtaining permission and opening the mine which was otherwise closed. The variable cost is $390 per ounce. The expected gold price in 1 year is $400 per ounce, and the going discount rate is 15%. So if you look at this situation, the variable cost is $390 per ounce, and the expected gold price is $400 per ounce. So the expected profit is very less, just $10 per ounce of gold, and the amount of gold is 40,000. So in such a situation, if we use the NPV approach, net present value approach, we will find that initial investment is $1 million, and in the next 1 year, the total number of, total amount that you can make, or the total money that you can make, is 40,000 ounce of gold multiplied with $10, and this can be discounted at 15%, right? In such a situation, as already, even if you don't discount this amount, you will find that there is a loss, because the investment that you have made is 1 million, and what you are going to get for, you know mining out and selling 40,000 ounce of gold is just, say, 40 lakh US dollars. So even without discounting it at 15%, you have a clear idea that this is a loss bearing proposition, because the cost involved is very high and the profit margin is very, very narrow. Are we together?
Yes,
Yes,
sir.
sir.
Sure.
Okay. So the discounted cash flow analysis, it ignores the option not to produce if it is unprofitable to do so. So it just gives you a negative figure. Those of you who want to calculate, you will find that there's a negative value of 6,52,174 US dollars. So there is a loss which is clearly visible. So nobody who is following the net present value approach will go after this. However, maybe some information is made available. Suppose the gold price next year is either 300 ounce with a probability of 0.5. That is, there's a 50% chance that the gold price next year will be 300 ounce, $300 per ounce, or it will be $500 per ounce, right? So in such a situation, you have a choice. Now, giving the concept, if you are being guided by the concept of growth option, what you can do is that if the gold price is 300 ounce, then you do not mine. Do not enter into the mine. Maybe you have put in that money, $1 million. So whatever caution money and other penalties that you can, pay that and take the remaining money, and do not mine, do not dig in for gold. However, if the price is $500 per ounce, now in such a situation, the profit margin is high. It is $110 per ounce. So in this case, you should go for mining of gold, right? So given this framework, you can now considered that there is a growth option, and that based on that growth option, if you do this analysis, so your expected return would be, you know based on the concept of probability, that if the probability is zero point 0.5 for the $300 per ounce price, then do not mind. So in that case, you get zero. But if the gold price is 500 dollars per ounce, and then you will go for digging the gold, and that $110 multiplied with 40,000, so that is the amount of profit divided. Obviously, it is, the probability is zero point 0.5, so you can divide it by 2. So the amount of money that you are going to get from that, and if you discount it for using the 15% discount rate, so in such a situation, as it is mentioned here, you will have a profit of roughly, you know 9 lakhs and 13,000 US dollars, right? So this is a another way of looking at situations. The takeaway or the learning part is that we should not consider the projects as, static or kind of dead entities. I mean, as long as there is life to the project, it can generate different possibilities in the wake of some new information, in the wake of some new political or economic development taking place. As we have already seen, and we are all witness to this pandemic, that on one hand, no doubt this pandemic has spelled disaster for so many families, but at the same time, it has been, kind of a trigger for the setup of so many new types of businesses, especially the new startups and the mobile smartphone app based businesses, online transactions, online education mode. So even the online consultation with the doctor. So many things, you know have become, kind of possible because of the, you know the situation that we are all passing through. Before we wind up, is it clear? बात समझ
Yes,
में
sir.
आई? ये ग्रोथ ऑप्शन का जो
Yes, sir.
कंसेप्ट है,
Yes, sir.
so it is a very unique concept. I'm sure you might not have come across such concept prior to this. That generally in the analysis, we move with certain assumptions, and we continue with that. However, in real life, the things are not static, things are not dead. They keep, the events keep taking different turns, and which may go in favor of the business, which may go against the business, and accordingly you have to take your, you have to make your business decisions in the light of such changes or developments which are taking place. The growth options, number one, they are based on certain, factors. Number one is the length of the time the project can be deferred. So the greater is the time of the project, greater is the value to the project, right? Maybe you have a short term project for 1 year. So compared to that, a project having a life of say 2 years or 3 years, you can say that the one which is having a higher, time to maturity, it has greater time value. You never know that maybe in the first year there is some problem or some losses, but in the subsequent years it can turn out to be profitable. The risk of the project is also very, very important. Obviously, all of us know, and this has been proved time and again empirically, in not only in academic studies but otherwise as well, that the greater is the risk, then the returns are also very, very high. commensurate. The returns are also similar, right? If there is no risk involved, then very less, uh, very normal types. There are no super normal or level of interest rates is also high level of proprietary, ownership of the project or some technology or some something which no other organization can copy or imitate. Then in such a situation, I mean these all these factors, they contribute towards a positive growth option for the firm. Other important things which we'll discuss before we call it a day today. Number one, the value addition to any project favors in putting additional investments in an option in your business, so that option should be kept open. The other is, this is also very interesting and important and very conceptual thing, the suspension option, that temporarily for the time being you can suspend the operations of a project which for the time being not appearing to be profitable, so you can for the time being suspend the options. And one last thing is, obviously when you see that there is no scope of improvement, when there is no scope of profits, then in such a situation, this is obviously considered to be the last resort. That is the abandonment option. This is the option to quit the investment early, right? So that is what we have seen, in fact, in the previous example of the gold mining, that using that approach, the discounted cash flows, that you did not consider the other option, and you just looked at that this uh, opening the mine and mining the gold at a very narrow profit margin, it would be it would not be profitable. It is going to be say loss bearing. So that, I mean, that ultimately leads to nothing but you just don't follow that at all. Or the otherwise, if the market price of gold turns out to be $300 per ounce, then in such a case you can abandon the project, right? You can leave it before going further. You don't go for further mining. Okay, is it okay?
Yes, sir.
Yes, sir.
Okay, so leave it here, and inshallah on Saturday we meet. We'll try to discuss some more project appraisal. Thank you so much.
Process.
Thank you, sir.
Thank you, sir.